Hey everybody, happy 4th of July for all you Americans and happy 4th of July for everybody else too. But awesome to be here for our July 4th edition of Wall Street Winners. Let's dive right in. And this is the July 4th edition of our disclaimer. Okay, so things are very interesting in the marketplace right now. And they're interesting from two perspectives. Number one, we said that there should be a rally here really through the month of July and August because of seasonality. And we started out the rally, and then last week we kind of got kicked in the teeth a little bit. But on Friday we said, no, the rally's back in. So that's number one. Looks like we have a rally, but it's a weak rally. Not unexpected. The second thing is we're seeing huge rotation in the market. All the stocks that we made money on early in the year, like energy and so on and so forth, and all the things that worked terribly in the beginning of the year, which fortunately we didn't have, like high technology stocks, biotech, they're all reversing, and they're the ones that are leading the market higher. Now, I told fully paid up members this last week, and this week we have a lot of trades to take advantage of that change, that huge rotation that's going on. Now, Dow Jones, let's go back here. Sorry, the S&P, the big gap, we broke up through it. That's good. Still another gap above the market. That's usually resistance. And you can see the purple predictor is below the price, which is a little bit bearish. None of this is any big deal. Dow Jones, on the other hand, you can see we started to see an increase in selling pressure. That's the red line. And a decrease in buying pressure. Now, this follows along what I'm saying about this massive rotation that's going on, where we're shifting away from Dow stocks and we're shifting into NASDAQ stocks. And I think that's going to last for 2 months. I think this whole rally phase that we're in is going to be a return to 2021. Oh, such a good year. Such a good year. All right, so here's the NASDAQ. Once again, so see, we got up to the top gap there. We filled that. Whereas with the S&P and the Dow, we only got into the bottom gap. So it shows that the NASDAQ is stronger. Notice the purple predictor, quite strong during this rally phase. Not really saying too much here at all at this point. But nonetheless, NASDAQ is going to be leading the way to the upside. So seasonality. We're in a neutral seasonality period, so nothing to do here. Now, we are in a bullish seasonal period for the utilities, but we always filter the utilities by price action. So you can see Utes have done very, very well here over the last couple of weeks, but we won't get back long Utes until we get some type of a break of a previous high. Until then, we're making lower highs and lower lows. That's the definition of a bear market. We don't fight the market. We go with the market. So here's on Stock Traders Almanac, here's their phase right here. This is the phase we're in right here. Little rally for a couple more weeks, then one down week, and then a couple more up, then sideways. And this period, I believe, is going to be all NASDAQ all the time. Biotech is going to lead the way on the upside. Energy stocks, boring. They're going to go lower. Commodity stocks, going lower. All the things that worked in the first 6 months are going to fail over the next 2 months. But we might go back into all those themes again once we get into this big bear move that ends at the beginning of November, end of October. All right, so we're going to watch it during this sideways period to see which sectors take the lead. And guess what? We'll go where the action is. Asset allocation, we saw money flow out of the stock market. But if you look at it from a week ago, about unchanged. Our riskicator continues. Look at this gigantic bear market in the riskicator. So even though stocks are in a bull move, this is saying they're going into less risky stocks, but we'll take a look. We'll keep an eye. Global shares. All right, we're going to finally get short these global shares. You can see they're much weaker. We saw the S&P get into this gap. The high here was in this gap. The NASDAQ got up to the high of this gap. But here, we're just barely off the lows. We're about to break down. So guess what? I'm going to get short some EFA. That's basically global shares ex-US. Now, this is a big dramatic change here. So even from last week when I did this broadcast for you, we had the yield curve at 1.70. So, and that's what that is that's the 10-year Treasury note minus the 3-month Treasury bill, okay? And this is the best yield curve. It's 18 out of 18 since World War II. So when it gets to zero, whoa, look at that. So this thing has collapsed from, it was about 170. We're now down at 115. Really, once we get down below 110, I'm going to count that as a flat yield curve. And of course, if it gets below 1.00, it's a negative yield curve. Take a look over here in the lower left-hand corner. You can see it's pretty flat, starting from 2 years out to 30 years. Pretty flat. One little rally here, and then it goes back down. But what happened is that this short-term yields, which are under control of the Fed, the 3-month was down here at the beginning of the year. Now it's way up here. It just has to go up about 50 basis points, and we're going to be up here, and the yield curve will be flat. So we have already had one negative sign, one negative yield curve, 2s, 10s. If we get, and that's 14 out of 18 correct prognostications. Now we're about to get the 3-month to 10-year, which is so far never had a failed signal. And you can see it's collapsing. It's totally collapsing. Very important. And the reason it's collapsing is because 10-year treasuries are going up, which means lower interest rates, and the Fed is raising short-term interest rates. So that's causing the yield curve to flatten dramatically. Both ends are moving in a direction of flattening, or moving from a more positive to a less positive. So that's incredible. And it looks like we're going to continue to move higher on the Treasury notes or bonds, because look at the purple predictor has just taken off. The smart money's coming in here and locking in these high interest rates because they think we're going to have a massive recession. And guess what? We will. All right, here you can see our signal, our bond key indicators are all collapsing, saying that interest rates are going to go lower. All of them are going down. So high interest rates, not for the next little while. Like I say, and I think it's going to coincide with the 2 months that we're going to see the stock market rally. Lower interest rates are going to stimulate the stock market. Then the fear of a gigantic recession will kind of become a little more important. Dollar rallying. We're back up to the old highs here. I think we're going to break through, and I'm going to get long the dollar this week. Going to try to anyway, because U.S. interest rates are going up faster than any place else in the developed world. There are some third world countries that are raising interest rates faster, but we're not really trading Turkish bonds, all right? So we don't really need to pay any attention to those. But of the developed countries, Europe, Canada, Australia, Japan, etc., the U.S. has the tightest monetary policy, and that's causing money to flow into the dollar. This is a chart of gold, okay, gigantic formation. I showed this to you last week, and look at this. We got down to the lows. We got down to the lows. So there's 1, 2, 3, 4 times we've gotten to those lows. Probably going to break down. Probably going to break down. Now, why do I say that? Because I go to our key indicators. There are no bullish key indicators. You can look right up here. Here's the top indicator. This is the Japanese yen, basically sideways. The CRB index, which is commodity prices, going down. And over here, you can see that the yen, it's going down. So 2 out of 3 of our indicators are bearish. 1 is neutral. So is it a wildly bearish situation? No, but it is bearish for gold. So do not listen to the Johnny One Notes. They drive me nuts because all they're trying to do is sell you gold or a newsletter. I'm trying to make you money. Crude oil. Now, I told you before, we got out of our crude oil positions, our energy positions back over here, a couple days after the high. And you can see the purple predictor remains bullish, and the price action is perking up a little bit. And I think what we're going to do is we're going to see a market try to get up to the 120 level, where I don't think we're going to surpass these highs at all. And the simple reason is this: supply is still very tight for oil. And that's why we're seeing this little rally here. News came out that OPEC was 400,000 barrels a day under their quotas, and they can't reach the quotas. So even though they have a quota, which would probably, if they matched it, it would cause a bear market in oil, they can't even get there because of countries like Venezuela can't pump at the rate that they're expected to. Okay, here's the problem, and here's why we're not going to make a new high. We got a recession. And we're seeing already parts of the manufacturing sector are in a recession, okay? So by the time we get to fall, all manufacturing basically is going to be in a recession, and we're going to see the services sector under pressure. Now, there's only been one recession since World War II where the service sector went into recession, and that was 2008. So we have to assume that it won't, but the manufacturing and wholesale sectors of the economy, they're toast. They're toast. That's my official economics prognostication. They're toast. Okay, so that's going to cut the demand for oil, and oil will go into a major bear market. Okay, Bitcoin. You can see that the smart money, which had been supporting, that's the smart money, that's the on-balance volume or purple predictor. It was very, very stable, and they held up Bitcoin. And then the smart money said, you know what? This Bitcoin is just, it's garbage. And so you can see the smart money just sold like crazy, and that's what cracked the price of Bitcoin. Now, here we are now, drifting lower. Here's what's going to happen. We're going to see a 50% drop in Bitcoin from where we are now. So we're going to see a low in this bear market, I think, of about 10,000, give or take 1,000, okay? Write that down. See if I'm right or not. I was right the last time we had a major bear market. I think I'll be right this time. But this rally over the next 2 months, I think, can support the Bitcoin price or the crypto prices in general because Bitcoin has become highly correlated with the NASDAQ. I'm saying not just Bitcoin, I mean all cryptos. And so if the NASDAQ is rallying over the next 2 months, we'll probably see Bitcoin show some stability or some increase. But when we told you last year that Bitcoin was going to be into a major bear market, it was because of tightening monetary policy, because it was a bubble last year. The NASDAQ was a bubble last year. The bond market was a bubble last year. Real estate was a bubble last year. And we told you all four of those were going to be in bear markets. So the only one that's not in a bear market yet is real estate, and it's going to always be the slowest mover. We already see a massive decline in the number of new home sales, of existing home sales. Prices are still going up because only rich people can buy houses now. So we're about to go into the phase now where all houses start to go down, and housing prices are going to go down, and they're going to be crippled in Australia, and Canada are going to be hit the hardest. So I'm digressing here. Here's my point. If Bitcoin breaks this low, I'd add to my short position. It's that simple, okay? Or any major crypto, let's say, but Bitcoin's been the strongest, okay? Ethereum and most of the others have been weaker, so you want to probably be shorting those rather than shorting Bitcoin. But Bitcoin has futures contracts, so that makes it pretty easy to short it. So Bitcoin should go down, but I don't think it's going to go down too much. This leg the NASDAQ will drag it up a little bit, and then the next leg down, which will probably follow the stock market, will take us down to about $10,000, give or take $1,000. I don't know, maybe 2,000, but I think we'll be pretty close to $10,000 on the downside. All right, freebies, you know we love having you here, and you know that you're just being foolish if you don't subscribe. Hey everybody, Courtney Smith here, and I just wanted to kind of reveal with you one of my secrets of my success, and that is I use a website called stockbutler.com, and the reason I use it is because it saves me so much incredible time, and it was based on my forms of analysis. The Stock Butler was developed by one of my brilliant students. Of course, all my students are brilliant, you know that. And he designed it around my technique for fundamentally selecting stocks. So all you have to do is you come here, you go to rate, you go to best of the best, that's the name of the technique, and bingo, there's the list. And then, since there's only 4 stocks there, no problem. Go up to rate, go down here to advanced stock list. I usually change this to main E table, update the list. Anything in green, I'm interested in. Now, I know that these are fundamentally powerful stocks. Now, all I have to do is go find the correct technical entry and exit point. So, Stock Butler saves me a tremendous amount of time, keeps me focused on only the best of the best stocks instead of wasting my time on other garbage. All right, everybody. We'll see you later.